Welcome to the Deep Dive. Today, we're taking a bit of a shortcut. We want to get you seriously well-informed about long-term investment principles. And we've got, well, a pretty unique source for that. We're diving into the 2018 annual letter from Fundsmith, the one written by CEO Terry Smith to the fund's owners. And look, this isn't just some dry financial report. It's more like a masterclass in strategic thinking, really packed with insights on performance, the whole investment philosophy, and a rare look behind the scenes at how a top fund like Fundsmith actually operates.
Exactly. And that's the key thing, isn't it? Our mission today really is to help you pull out the practical wisdom from what might seem like, a really dense document. We want to show you how to find those enduring principles, focus on what really matters for your investment journey, not just the headline numbers.
All right, let's get into it then. Let's unpack this. We should start with the landscape of 2018. It felt like a turbulent year for a lot of investors, right? Fundsmith Equity Fund delivered a total return of plus 2.2%.
Yeah.
Now, on its face, that sounds kind of modest. But what does that number really tell us when you put it in context?
It's actually pretty remarkable. That plus 2.2%, which, was their weakest absolute return since they started. It was actually a stunning success in relative terms. The letter points out that out of over, 2,500 UK Investment Association mutual funds, a huge 92% had negative returns in 2018. Negative. Fundsmith, they landed in the top fourth percentile, meaning only about 3% of funds did better. It was actually their second best year ever relative to all those other IA mutual funds. So context is everything here.
And the letter definitely touches on all those anxieties floating around in 2018. Smith lists them off, doesn't he? You had the U.S.-China trade war stuff, Brexit looming, U.S. interest rates going up, the U.S. midterms, even that Italian budget issue.
Yeah, which was significant, Italy being the third largest government bond market. He acknowledges all these things led to, as he puts it, market jitters.
But he pushes back hard on the turmoil narrative.
He does. He argues that all those sort of hysterical headlines and the constant talk of turmoil were, frankly, overblown if you look at the bigger picture. He gives this really vivid anecdote from Black Monday, October 19th, 1987. The Dow just plummeted 22.6% in a single day.
Wow.
And he was there on the trading floor, literally writing sell orders by candlelight because a hurricane had knocked the power out.
Okay, that's turmoil.
Exactly. He contrasts that sort of visceral experience with a Financial Times headline from December 2018 calling a 3.1% Dow fall eye-popping. He kind of amusingly wonders what might have popped if they'd seen a drop 7 times bigger, like in '87. And his point is, Black Monday barely even registers now on a long-term chart of the Dow. It really forces you to rethink what market turmoil actually means.
That's such a powerful perspective. It really puts those day-to-day swings into context. And this leads us straight into a really crucial concept the letter hammers home, the futility of market timing. Smith has this very strong, almost defiant view on trying to predict the market's ups and downs.
Oh, absolutely. He doesn't just say it's futile. He lays out exactly why it's such a dangerous game. He distills it down into 7 key principles, really truths, about dealing with downturns and predictions. The first one, nobody, absolutely nobody, can reliably predict market downturns. He uses that famous Michael Fish analogy, the weather forecaster denying a hurricane right before it hit the UK in '87.
Right, I remember that.
Second, and this is huge, forecasters completely ignore the massive gains investors miss out on by following advice to avoid downturns that never happen or happen differently. He points out Fundsmith itself was up over 185% during 6 years when people were constantly warning its strategy wouldn't work anymore.
Okay, so ignoring the noise paid off. What else?
Third, bull markets don't just die of old age. They usually end because of specific events, often rising interest rates. Fourth, they climb a wall of worry. All those visible, troubling events everyone talks about. They're rarely the actual cause of the bear market. He uses Greenspan's irrational exuberance comment in '96 as an example. That was followed by the Asian crisis, the Russian default. But paradoxically, those crises made the Fed hesitant to raise rates, which actually extended the bull market until 2000.
Interesting twist.
Fifth, bull markets tend to narrow as they get older. The gains get concentrated in specific sectors, like U.S. tech, the FAANGs in that later stage. So switching into lagging stocks late in the game, that usually goes against all historical experience. Sixth, buying so-called value stocks. Well, that's best done after the bear market hits, not before you think it might. True value hunters look for yield higher than the PE ratio in a downturn. And finally, number 7. Look, a bear market is going to happen. It's inevitable. But the best approach, ignore it. because you can't predict it accurately or position for it effectively without likely sacrificing huge gains along the way. Now, that requires, as he says, significant emotional and financial stability. And that's the tricky part for most people.
It definitely is. That emotional stability, that's the real challenge, isn't it? Standing firm when everyone else is panicking. How does Smith kind of subtly tackle that psychological barrier, that fear of buying at the top?
He uses this brilliant visual aid. He shows a chart of the S&P 500, but without dates initially. It runs from 1928 up to 1965. And you look at it, this long upward climb with maybe a bit of a wobble near the end, and your gut reaction is probably, whoa, no way I'm investing now. It looks like it's about to fall off a cliff.
Yeah, that would be my instinct.
Exactly. But then he reveals the dates. It stops in 1965, the exact year Warren Buffett took control of Berkshire Hathaway. His point is, if you tried to time the market then, held back because it looked too high, you'd have missed out on Berkshire's incredible, 20.9% compound growth afterward. And ironically, the market actually went up 13% in the rest of 1965. Yes, it fell 22% in 66, but Berkshire,
Okay.
only down 3.4%. It just demolishes that wait for the fall mentality.
Okay, that's a great illustration. But then he shows another chart, right, from 1965 to 2018. And it looks, well, pretty similar, that same long upward climb, which might trigger the same reluctance. So you might think, okay, but surely things are different now. Valuations must be way higher today.
But he anticipates that argument. He directly tackles the things are different this time excuse. He points out that back in mid-1965, the S&P 500's price-to-earnings ratio, the PE, was 18.6. At the time he wrote the letter early 2019, the forecast PE for the S&P 500 was actually lower, 17.1.
Oh, really?
Lower. So by that measure, the market was arguably less expensive or more lowly rated than it was back in 65. It really undermines that justification for sitting on the sidelines. Market psychology often rhymes, as they say.
That's fascinating. Okay, let's move on to the core of their approach.
Yeah.
This next bit is gold, I think. Fundsmith's investment strategy. It's boiled down to just 3 incredibly simple steps. Buy good companies, don't overpay, and do nothing. Let's dig into each of those.
Right. The first step, buy good companies. It's not just a slogan. You see it clearly in the numbers, the financial DNA of their portfolio. He compares their portfolio's look-through characteristics to the S&P 500 and the FTSE 100. And the differences are stark. Consistently higher returns on capital employed RCC. It was 29% for Fundsmith in 2018 versus 16% or 17% for the indices. Nearly double.
That's a big gap.
Huge. And better profit margins, too. Gross margin 65% versus maybe 40-45%. Operating margin 28% versus 15-16%. Plus, really high cash conversion, 95% of their company's profits turn into actual cash. And they're financially stable. Interest cover's way higher, like 17 times versus 7 or 9 for the indices. And get this, the average founding year for the companies in the portfolio, 1922. These are businesses that have been around, proven their resilience.
Wow, 1922, so established quality businesses. And they're not just stable, they're growing too, right?
Absolutely. The weighted average free cash flow growth for the portfolio was 8% in 2018, which is pretty solid, especially after a really remarkable 13% growth the year before in 2017.
Okay, so that's buy good companies. What about step 2, don't overpay? How do they think about valuation for these quality businesses?
Yeah, don't overpay. They look closely at the free cash flow yield. For the portfolio, this actually moved from 3.7% up to 4.0% during 2018, which means, on average, the companies actually got a bit cheaper relative to the cash they generate. Smith sees this as a healthy thing, especially if you're adding money regularly, like through accumulation shares.
So cheaper is good, but are these companies absolutely cheap compared to the market?
Well, the letter acknowledges that Fundsmith's companies, being higher quality, are valued a bit higher than the S&P 500 average, and definitely higher than the FTSE 100 average. But the argument is that you're paying a fair price, not necessarily a bargain basement price, for superior quality and, crucially, their ability to compound value over time. It's not about finding distressed assets, it's about fair value for excellence.
Makes sense. Okay, and the final step, the one that sounds easiest but is probably the hardest for most investors, do nothing.
Ah, yes. Do nothing. This is where they really differ from the crowd. It's all about minimizing portfolio turnover, buying and selling. In 2018, their turnover was 13.4%. Now, that was actually their highest ever up to that point, but it's still absolutely tiny compared to most funds.
13% is high for them.
Relatively, yes. And he notes it was even a bit exaggerated because they were deploying some spare cash when the market looked weak. The actual cost of their voluntary dealing, the commission, spreads, taxes when they chose to trade, was just 0.018%. That's 1.8 basis points, basically nothing.
Incredible.
And think about this. 11 of the companies in their portfolio have been held right from the start since the fund launched back in 2010. They buy and hold. Most funds are constantly churning.
So this ties into costs. Minimizing costs is obviously a big part of the do-nothing philosophy and achieving good long-term results. How does Smith talk about Fundsmith's costs compared to others?
He makes this really important distinction between the ongoing charges figure, the OCF, which is what you usually see quoted, and the total cost of investment, or TCI. The problem with the OCF is it often leaves out significant dealing costs, the commission, the bid-offer spread, transaction taxes. These can quietly add up.
Ah, the hidden costs.
Exactly. Fundsmith's TCI in 2018 was 1.09%, which was only 4% higher than its OCF. Now compare that. He looked at the 15 largest UK equity and total return funds. For them, the average increase from OCF to TCI was 23%.
23%. Wow.
Yeah. It really highlights Fundsmith's focus on keeping all costs low and being transparent about it.
But the letter insists costs aren't the only thing, right? It's performance after costs that counts.
Precisely. Costs matter hugely, but ultimately it's about the net return you actually receive. And the letter includes a table showing Fundsmith equity leading its peer group pretty convincingly. Over 3 years at that point, 16.9% annualized return. Over 5 years, 17.9% annualized. That's after all fees and costs. Strong outperformance.
Okay, let's switch gears slightly. Terry Smith often uses the term value investing, but he puts it in quotation marks value. Why does he do that? What's his perspective on traditional value investing?
Yeah, those quotation marks are deliberate. He's making a few key points. First, just because a stock looks cheap, has a low rating, doesn't automatically make it good value if the underlying business quality or its future prospects are poor. Lowly rated could just mean bad business.
Right. Cheap for a reason.
Cheap for a reason, exactly. Second, he quotes Warren Buffett, arguing that the whole distinction people make between growth investing and value investing is kind of superficial. Buffett's point, which Smith echoes, is that growth is always a component in the calculation of value. You can't separate them neatly. Smith sees traditional value investing as buying something significantly below what you think it's intrinsically worth, often waiting for some catalyst to make the market recognize that value and then selling. It's quite an active strategy, actually.
Okay, so how does Fundsmith's approach differ from that?
Fundsmith's approach is different. They're not looking for statistically cheap stocks they plan to flip. They're looking for companies that can predictably generate high returns on the capital they employ year after year, and crucially, that can reinvest a good chunk of that capital back into the business at similarly high rates, creating this compounding effect, and then they want to hold them, ideally forever. And he throws in this counterintuitive stat. During the 2007-09 financial crisis, the MSCI Europe Value Index actually fell 52%.
52%. Ouch.
Yeah, and that was 16 percentage points worse than the broader MSCI World Index, which kind of challenges that common wisdom that value stocks are safer and protect you better in downturns.
That definitely challenges the narrative. Okay, let's dive into the portfolio specifics from 2018. The letter breaks down the top and bottom contributors.
It does. The top 5 contributors to performance in 2018 were Microsoft, making its 4th appearance on that list, by the way.
Wow, consistency.
Yep. Then IDEXX, Intuit, which was a newer holding from 2017, PayPal, its 2nd year on the list, and Dr. Pepper Snapple, which got a takeover bid. And Smith adds a little comment there. So much for taking profits as a strategy, highlighting the benefit of letting winners run.
And the bottom 5. The ones that detracted from performance.
The bottom 5 were Philip Morris International, Sage, Facebook 3M, and Novo Nordisk.
Okay, Facebook.
Oh.
That was definitely a controversial name to be holding in 2018, given all the headlines. Let's dig into that one. Why were they holding it?
Yeah, Facebook was under intense scrutiny, but Fundsmith's decision, as the letter explains, was rooted in the numbers. Looking back at 2017, the metrics were just phenomenal. Return on capital, 30%, gross margins, 87%, operating margins, 50%. I mean, incredible profitability.
Hard to argue with those numbers.
Right. And revenue growth had been 49% per year for 5 years, operating profits up 106% per year, just explosive growth. Plus, the user numbers were staggering. 1.5 billion daily active users, DAU, 2.3 billion monthly active users, MAU. Basically ubiquitous, especially considering they weren't even in China.
So the underlying business was incredibly strong, despite the noise.
That was the thesis. Even amidst the media storm about data misuse, in Q3 2018, revenue still grew 34%. Okay, they guided for slower growth in Q4, maybe mid-20s, but still strong. And the operating margin was still an impressive 42%.
42% margin, even with all the problems.
Yes, and importantly, that 42% margin was after costs had surged by 53%. They were spending heavily, R&D up to 29%, marketing and sales up 65%, general and admin up 76%. Fundsmith interprets this spending not just as firefighting, but as a strategic investment to address the issues, build bigger moats around the business, and solidify its competitive position long term.
So seeing the cost increase is a positive in a way, building defenses.
Potentially, yes, as a way to handle the controversy and make it harder for competitors. There's also this interesting little detail mention. Facebook's new political ad transparency tools revealed the UK government itself spent nearly £100,000 on Facebook ads promoting Theresa May's Brexit deal. Shows the platform's reach, I guess.
Huh. Interesting aside, what about cash flow?
Even though capital expenditure doubled in the first 9 months of 2018 to almost $10 billion, their Q3 free cash flow was still 16% higher than the previous year. That cash generation was immense.
So strong fundamentals, huge user base, massive cash flow. What about the valuation? Was it expensive?
Well, despite all this underlying strength, because of the controversy,
Yeah.
Facebook was trading at an historic PE ratio of just under 20 times, similar to the overall S&P 500 index. Smith basically argues that was cheap for a business with such dominant characteristics, especially in the online advertising market where it had that virtual duopoly with Google.
And what about the global user base? Did that play into their thinking?
Absolutely. A key point. 69% of the daily active users and 73% of the monthly active users were outside the US and Europe. The implication being maybe those users didn't care as much about the specific US election data misuse allegations, and user growth continued, supporting that idea. There's also this slightly amusing anecdote in the letter. Someone actually contacted Fundsmith to query their Facebook holding using WhatsApp, which of course Facebook owns and hadn't even started monetizing properly at that point.
Huh. The irony.
Right. It kind of perfectly illustrates their core philosophy on this. The only time you can hope to buy stock in great businesses at a cheap valuation is when they have a glitch. They saw the Facebook situation as a glitch, an opportunity.
That's a fascinating deep dive into one holding. But the letter also gives insight into how Fundsmith interacts with companies beyond just the numbers, their corporate engagement.
Yes, and it's quite involved. They don't just buy the stock and sit back entirely. They meet management, they go to result presentations, industry conferences, they engage with board remuneration committees, and crucially, they vote on all resolutions and proxy statements themselves. They don't outsource that to proxy agencies, which is quite common.
But they also say meeting management isn't the main test.
Correct. They emphasize that the quality of a business should be evident from its financial track record, from the numbers. Meeting management isn't the primary filter, and they're not there to tell management how to run the company. They assume good managers know that. The engagement is more strategic, more about governance and long-term alignment.
Okay, let's look at the case studies. First, Sage, the UK software company.
Right, Sage. The UK's largest listed IT company. They were going through this big transition to software as a service, or SaaS. And they hit a rough patch in 2018, some disappointing quarters, concerns about product development. So Fundsmith engaged directly with the chairman. They could draw on their experience as shareholders in Intuit, which had navigated a similar SaaS transition very successfully.
So they brought relevant experience to the table.
Exactly. Following those discussions, the Sage board decided a change was needed and the CEO was replaced. Fundsmith then engaged again with the chairman, this time about selecting the new CEO. They even used Microsoft's CEO change from Steve Ballmer to Satya Nadella as a positive example of getting leadership right. Then they met the incoming CEO to really stress the importance of focusing on long-term success, even if it meant some short-term pain. This perspective supported the new CEO's decision to invest an extra £60 million, mostly into product development.
That's quite hands-on, strategically. What about the Unilever case? That was very public.
Yes. Unilever's plan to ditch its dual Anglo-Dutch structure and move its main headquarters and listing to the Netherlands. Fundsmith was skeptical about the official reason, given that it was mainly to simplify making large acquisitions. They suspected it might have more to do with Unilever's brush with a hostile takeover attempt from Kraft Heinz a year earlier, and perhaps also seeing what happened with Akzo Nobel, another Dutch company, where management and politicians seemed to work together to fend off a bid from PPG Industries. That raised concerns about entrenchment.
So the concern was about reducing accountability.
Pretty much. Fundsmith believes the possibility of a hostile takeover, even if unwelcome, acts as an important discipline on management to ensure they're running the company well for shareholders. Their discussions with Unilever's chairman focused on this principle. They noted the chairman didn't seem to agree with that view. And interestingly, the letter points out that while Fundsmith made its views known privately, they didn't publicize how they intended to vote on the Unilever proposal. They believe effective stewardship isn't always best achieved by shouting from the rooftops in the media. Sometimes quiet, firm engagement is better.
That's a really interesting insight into their behind-the-scenes engagement. So bringing this all together, we started this deep dive talking about market timing, those S&P 500 charts that can make you hesitate. As you, the listener, reflect on everything we've unpacked today, Fundsmith's simple strategy, their focus on quality, their patience, their engagement, maybe think about your own reactions to market ups and downs. How do you process that constant stream of news and opinion?
And maybe I can leave you with one final thought, another quote used in the letter, attributed to Mark Twain. History doesn't repeat itself, but it often rhymes. It's a good reminder, isn't it? To contemplate the things that don't change, much like market psychology. The power of compounding versus getting caught up in the endless cycle of short-term predictions and anxieties. It encourages that long-term perspective.
A perfect thought to end on. Thank you for joining us for this deep dive into the Fundsmith 2018 letter. We hope these insights offer some valuable perspective for your own investment journey.